Now, let me start with thanking Jeff Gendel and the Private Equity International for inviting me to be here. With 2,300 private equity firms in the United States, 8 million employees of companies that you own worldwide, the private equity industry is an extraordinarily important part of the economic puzzle, and it's one that is not as well known, well, it's better well known today than it was when the presidential primary started a year ago, but it's not as well known as it ought to be. The fact is that private equity invested $150 billion in U.S. companies in 2010 alone. You make companies better, stronger, and more competitive, and the American economy gets a double whammy of strength from your actions. One is by definition, you create a stronger company than the one you inherited or purchased. And secondly, that stronger company, by raising the competitive edge, makes the whole industry stronger and thus the entire economy stronger. Now, as painful as it may be to see your industry discussed in presidential politics, I would contend to you that that's actually beneficial and good, because as the debate occurs, or has occurred and will occur, the American people will understand it. They'll understand the facts, and they'll understand that it is a positive effect on the economy. So as painful as it is to sort of have your industry discussed out in the Wall Street Journal and on CNBC, which it already was, but on ABC, it's good for you. When the American people look behind the veil, they see that through you, major companies like Staples, Hilton, Sports Authority, Dunkin' Donuts, and so many more employ hundreds of thousands of Americans and create billions of dollars of wealth, and you brought that to America. Now, let me start with a word about the economy, and this is just my views. Somewhere in the Bible it says that in the beginning there is the economy. So as we start 2012, it seems to me that while there's a good deal of debate about where the economy is going, it seems to me most observers at this point, including myself, are cautiously optimistic. The outlook for 2012 looks reasonably good and reasonably robust, that things will continue to improve, or reasonably solid perhaps not robust, but solid. Now, I did note that you all did a poll about 4 months ago, 4 months ago anyway. 57% of you believe that the U.S. economy will at best remain stagnant, and 23% of you believe that a double-dip recession was likely. You were quite a pessimistic bunch back then, and many of you may still be. Some in small business are still pessimistic. The U.S. Chamber of Commerce published a poll yesterday in which an astounding 85% of small business believe that the economy is on the wrong track. But nevertheless, most of the indicators, it seems to me, would say that things are kind of moving forward over 2012 and then into 2013 in a positive way. Projected 2.8% GDP growth. Inflation is expected to continue low. Consumer confidence at a 7-month high. I mean, we take good news where we can get it at a 7-month high. Holiday retail sales solid, and online sales quite good. In my world of financial services, bank lending is reasonably robust, and particularly in the last 3 to 4 months. Aggregate bank lending is back to pre-crisis levels at $7 trillion. U.S. jobless rate, the economy, is a mixed bag at 8.6%, and while that's historically high and way higher than we can have as an economy that's robust, it's nevertheless moving in the right direction. So it's not a boom time, but I think that 2012 will be a year of steady growth. Now, outside the Beltway, then, moving from the economy to the financial services industry, the big untold story in America today is the role of the financial services industry is the role of maintaining and creating a quality of life and a standard of living. Quite simply, the financial services industry affects, and it's beginning to be understood, but it's almost been taken for granted, as if we just assume that that's the way it always had to be that way. The financial services industry finances everything, or it doesn't happen. If you live in it, work at it, wear it, go to school to study it, eat it, drive it, the financial services industry either financed it or it didn't happen. Main Street is beginning to hear that story and to understand it, but much of it is still unknown. Now, let me start with lending. Lending is back to pre-crisis levels at $7 trillion. Business lending was up in 2011, particularly in the year, by 8%, by $100 billion. Small business lending, which interestingly is not measured anywhere because there's not a consensus or an agreement on what makes a small business. But small business lending, we think, is up by about to a 4-year high in November. My organization, we did a survey of 40 of our large and medium-sized companies, mostly banks, but a few insurance companies, and we discovered that with only a couple of exceptions, small business lending was up in every single case by somewhere between 20 and 80%. You all saw the public pledges that on a political basis, but these companies stepped up. 20 companies stepped up and pledged an additional $100 billion in small business loans in the next 3 years. So we have a lot of anecdotal evidence that small business lending is robust. PNC, $1 billion in small business loans in the third quarter. U.S. Bank hit their all-time company record. Allstate Financial, an insurance company, invested over $165 million in equity to 2,000 women and minority-owned businesses. The big bank, J.P. Morgan Chase, $12.6 billion in credit to 300,000 small businesses, and so forth. Now, even the financial services industry back to lending in small business, but it's not back to the bad old days of making bad loans, nor should we be. A well-capitalized borrower with a proven cash flow and collateral is the test, and will continue to be the test. Second, safety and soundness, and we lost that during the crisis. The country was on the edge, and many financial institutions actually went down. But that safety and soundness of being a well-capitalized industry is essential. 2008 and 2009, financial institutions were collapsing, and the economy suffered. But as a result of some of the changes made by Congress and others by regulators, but mostly by market discipline and by the companies themselves, the financial institutions are back on a well-capitalized basis, eliminating risky practices, subprime loans, no-doc loans, bad underwriting. Great untold story is banks are at an all-time capital level, the highest capital level in American history at $1.5 trillion. Tier 1 capital is up by 51%. The industry we've undergone our stress test, as you could appreciate. Stress test, resolution plans, orderly liquidation put us in a far better place to finance the economy than a year ago, 2 years ago, and probably far better than in 2005. The industry has, on the housing side, the housing is still rough. Some glimmers of hope, some changes. We're 12 to 24 months away from working through the delinquencies, but the industry has done some 5 million permanent mortgage modifications for homeowners since 2007. We expect another million in 2012, plus refinancing underwater mortgages and clearing out some of the REO. So a ways to go on housing, but housing is beginning to show some signs of life. Now let me move from there to Dodd-Frank and inside the Beltway, because the fact is that all the action in Washington inside the Beltway is on the regulatory side. There's almost nothing in 2011 or in 2012 that's legislative. The Congress gets all the headlines, but the regulations and the regulatory agencies are most. Now, I read a survey from PEI that said that most of you most of you believe that, in your words, that complying with the new regulations is a, quote, difficult and time-consuming process. Well, welcome to my world, the world of regulated financial institutions. Just as one, we're trying to comply with 400 coming regulations, 2,300 pages of legislation in Dodd-Frank. One example, we now are required with a stress test, and it's a good thing, I suppose. That which does not kill you makes you stronger. But the stress test would specifically tell the large financially regulated companies that they have to both determine, write down, and report to their regulators today on exactly what they would do in 5 years in the event that unemployment went to 13% and the Dow Jones went to 5,700. So as I say, trust me, the regulated world is a difficult world, and welcome to it. It's been 16 months since the passage of Dodd-Frank, and since then, the regulatory agencies Well, they get a lot of criticism, I suppose, but not from me. They have been working quite diligently to implement the 400 some odd studies in Dodd-Frank. Now, as you all know, they're way behind. Only 22% of the rules have been finalized. Fewer than 1/3 of the rules that are scheduled to have been completed have been completed. In my view, and we used to sort of complain about that or wonder about that of being late, but in my view, it's better for them to get it right than to get it on time. So a few comments on Dodd-Frank, and then I'm going to turn it over to you. First is Dodd-Frank was at its heart. Dodd-Frank is a good thing, and it's hard to think of that because it's had a lot of things in it that need to be changed. But at its heart, it's designed to protect the system from systemic risk. The core of the economic crisis was that a bad decision in one place, poorly written mortgage or several billion poorly written mortgages, could and did infect the entire system, and compounded but with securitization, we created an ocean of toxic assets. And second, the second thing to note about Dodd-Frank, though, is that while any individual rule or regulation may in and of itself be harmless or even laudatory, the cumulative weight of Dodd-Frank is a problem into itself. You recall the famous question that Jamie Dimon asked Ben Bernanke, has anyone studied the cumulative weight? And Ben Bernanke very thoughtfully said, no one ever has. It's not our job to study the cumulative weight. So Financial Services Roundtable, we did a study in the sense that we reached out to others that have done studies and found all kinds of really bad answers on the cumulative weight from pretty credible sources, including 2.6% decline in GDP when it's fully implemented, a loss of 4.6 million jobs in the United States, and a $1.2 billion per year simply added on administrative cost or dead weight cost. So it's not the individual. There are some exceptions. I'll get to those, but it's not so much the individual rules as the cumulative weight. And third is, let me state that the regulatory agencies, which is the Federal Reserve, the FDIC, the OCC, the CFPB even, they're doing the best they can with the hand that was dealt with them, but they cannot change the statute. So my advice to my members and to you is to comment on everything that moves and then comment on the comments. The regulators read your comments and they use them to draft the regulation, but their first job is to follow the statute. And that leads me to my fourth point, and that is to be clear, the financial services industry, we've determined that it's time for Congress to review Dodd-Frank, the underlying statute, to hold hearings, to consider what they got right, which is a lot, but to reform the reform. Out of 2,300 pages conducted in the space of less than 6 months, and some people say much of it written in the last night of the conference committee, it's time for Congress to step up to its job to consider what needs to be changed. So let me offer a few. So let's start with the VOCA rule. I guess you all know about the VOCA rule, right? The VOCA rule is one of those things that is kind of like it's worse than a two-hump camel. It's kind of a two-headed donkey trying to go in two different directions at once. Some who were in favor of the VOCA rule wanted to simply reinstate the 1934 version of Glass-Steagall, and others want to use it only to limit proprietary trading using insured deposits. And Congress never reached a clarity on which goal they were trying to pursue, so they tried to pursue both of them. The federal regulators issued a proposed regulation in October, as you know, to implement the VOCA rule. So what started out as a 3-page letter from Mr. Volcker to Mr. Obama outlining his plan became 10 pages in the original Dodd-Frank statute and is now turned into a 300-page rule with 1,300 questions, 1,300 questions on 400 topics. Now, any 10-page statute that requires 1,300 questions on 400 topics to even think about implementing really just simply needs to be revisited. The VOCA rule, the outcome is not clear. I don't know what's going to happen, but I firmly believe that Congress will and should. They began this week with 2 hearings in the House Financial Services Subcommittee. Two different subcommittees took the first step towards some hearings. I do believe that the VOCA rule will be reexamined, revisited, and at some point in 2013 will be rewritten, and it should be. interchange fees, the famous Durbin Amendment. That was also one of those late additions to Dodd-Frank. Things were kind of a frenzy at the time in the Congress. Durbin Amendment had no hearing, no committee consideration, 1 hour of Senate floor debate, and the final Durbin Amendment was written in pencil by Senator Durbin on the Senate floor as he began to revise his own amendment as he went along. The Durbin Amendment is based on a flawed understanding of the factors that affect interchange fees. The industry, it's now cost the industry some $9.4 billion, which in various forms are passed along to consumers. And one estimate indicated that 76% of the retailers have not, nor could they have, or would they be expected, 76% have raised their prices or kept them the same, sort of contrary to the political belief that somehow they would lower their prices. So price controls never work, and eventually the Durbin Amendment will be repealed. Derivatives is one that needs some that needs a good deal of work. A couple of examples, and the idea of bringing transparency to derivatives world, I think, is a good idea. But there's some specifics of this that just don't work, such as transactions between affiliates of the same company shouldn't be subject to the same as transaction costs as with two different companies, or transactions between two foreign parties, including the foreign affiliates of a U.S.-based organization, shouldn't be subject to the U.S.-based regulation. This is the United States of America, not the United States of the world. The definition of the swap dealer should be given, obviously, a de minimis standard to avoid covering small entities with an insignificant level of derivatives. And the so-called Lincoln Amendment, which requires a push-out, simply adds cost with no value. The CFPB, the Consumer Protection. We're in favor of consumer protection. In some ways, the Consumer Financial Protection Bureau will do some good. It will bring consumer protection to the wild, wild west of the unregulated industry. But this whole debate over the appointment and the governance the debate over the governance of CFPB is real. The CFPB should be given a governance structure that's consistent with governance structures of other regulatory agencies, the SEC, the Federal Reserve, the CFTC, the FDIC, and others, and given a governance board as opposed to a sole director with unilateral authority. The CFPB their mission should be made consistent with law, so that the CFPB should be regulating and implementing underlying statute as opposed to writing the laws, themselves. And then it should also be consistent with safety and soundness. Capital. As I said a minute ago, before any of the implementation, the large banks have increased their Tier 1 capital by some 50%. Section 171 of Dodd-Frank in capital, so the so-called Collins Amendment, all that Congress would think of to do was to codify Basel I standards. Basel I was set in 1989. Since then, we've gone through Basel II, and we're already into Basel III. So the obvious thing, I think, for Congress to do is to start over and apply and start with Basel in 2012. We should start with Basel III, not with Basel I. Now, at that point, I want to stop and take some of the questions, which I'm going to have to sort of peek over here and see what they say. Take questions for you. I can take questions on presidential politics, on Dodd-Frank, on the committees in Congress, on the coming Senate, on any other subject they want, including if you want to know when the Dallas Cowboys are going to win the next Super Bowl, 2013. Easy enough. All right.